XRP Financial Horizon. I'm glad you're here because if you're holding XRP or even thinking about buying the dip right now, the next few minutes could change how you look at your portfolio for the rest of this week. There's a number buried in the blockchain data that almost nobody outside of hardcore analysts checks, and it just flipped for the first time since February. Stick around because by the end of this video, you'll know exactly what that number is, why it matters more than the price chart itself, and what levels to watch if things get rough. Here's the core of it. A whale tracking metric tied directly to Ripple's XRP just turned negative, and this hasn't happened in close to 4 months. This particular indicator, known as the XRP Whale Flow 30-day moving average, tracks whether the biggest wallet holders are net buying or net selling over time. For most of the last 4 months, that number stayed positive, meaning whales were quietly stacking coins in the background while retail traders argued about price targets on social media. Current on-chain data suggests that period of accumulation may have ended, and the shift happened fast. What makes this timing interesting is that it's not happening in a vacuum. The XRP ledger recently went through a technical upgrade, something that under normal circumstances you'd expect to boost confidence among long-term holders. Instead, recent on-chain activity suggests whales have been reducing accumulation, even as the network itself moves forward. That gap between the tech is improving and some larger holders appear to be reducing exposure is worth remembering, because it tells you sentiment among large holders doesn't always track with headlines about development progress. Let's look at the actual numbers because they tell a clearer story than any headline could. Back in early May, whale accumulation was running between 9 and 13 million XRP purchased per day. That's a strong, healthy pace. By the time we got into the back half of May, that number had fallen to roughly 4 million XRP daily, less than half of where it started. Then, just this past Tuesday, the flow dropped again, all the way down to 1.24 million. That's not a gradual cool down anymore, that's a sharp drop-off, and it lines up almost exactly with the point where XRP's price hit its recent high and then rolled over into a correction. One more piece worth mentioning here involves Ripple's own executive chairman, Chris Larsen. Some of his wallet addresses became active again during this same stretch of time. To be clear, the amounts moved were small and nowhere near large enough to influence price on their own, so this isn't a founder is dumping story. But when insider wallets wake up at the same time whale flow data turns negative, analysts tend to note it, even if it ends up being coincidental. Now let's shift over to the derivatives market because this is where things get even more revealing. Funding rates for XRP perpetual contracts on Binance have been sliding for weeks, and they just touched roughly negative 0.0139, the lowest reading in over 3 months. In simple terms, funding rates measure the cost traders pay to hold long or short positions. When that number goes negative, it means short sellers are now paying longs to keep their bets open, which tells you the market has quietly tilted toward betting on further downside. This wasn't always the case. Just a couple of months ago, funding rates were swinging positive on a regular basis, and those stretches actually lined up with some of XRP's stronger rallies, since positive funding usually reflects aggressive long positioning and buying demand. That momentum has clearly faded now. Here's the part traders should actually pay attention to, though. Extremely negative funding rates don't always mean more pain is coming. Sometimes they set up the exact opposite, a short squeeze, where too many traders betting against the price forces a sudden reversal once buyers step back in and shorts scramble to close. So where does the actual price sit through all of this? XRP touched a 24-hour low of $1.02 before bouncing to around $1.04, with a high near $1.05. On paper, that sounds like a stable recovery, but the detail that matters more is trading volume, which has stayed thin for several days straight. Thin volume during a period of falling whale support and negative funding usually means traders are hesitant, waiting for a clearer signal before committing either direction. That kind of standoff rarely lasts long. Analyst Ali Martinez has been watching the support structure closely, and he's flagged 0.90 as the first real level to watch if selling continues. Beyond that, using UTXO realized price distribution data, which basically maps out where large clusters of XRP previously changed hands, he identified 0.80, 0.62, and 0.51 as deeper support zones. These aren't random numbers pulled from a chart. They represent price points where significant trading history exists, which historically makes them areas where buyers tend to show up. Meanwhile, XRP futures open interest slipped nearly 2%, landing at $2.28 billion. Part of this pullback appears tied to fading confidence around the Clarity Act, the crypto regulation bill that traders have been watching for signs of legislative progress. As the odds of it passing weakened, open interest fell more than 0.5% on CME and over 2.3% on Binance. When open interest drops alongside falling odds on a major regulatory catalyst, it usually signals traders reducing risk rather than doubling down, which fits the broader cautious tone we're seeing across every metric today. On the ETF side, the picture is mixed rather than uniformly bearish, and that distinction matters. Spot XRP ETFs saw net outflows of $2.83 million on Tuesday, with the Bitwise XRP ETF responsible for the bulk of that at $5.82 million in redemptions. But Canary's XRPC fund told a different story, pulling in $2.99 million in fresh inflows during that same session. So even while one fund saw investors head for the exits, another saw new money coming in, which tells you institutional sentiment isn't fully aligned in one direction yet. If you're trying to make sense of all this at once, here's the simplest way to frame it. Whale accumulation has dropped from a strong pace to nearly nothing in 9 weeks. Funding rates just hit a 3-month low. Futures traders are pulling back their exposure, and ETF flows are split rather than clearly bullish or bearish. None of these signals alone would be alarming, but stacked together like this, they paint a picture of a market that's genuinely uncertain about its next move, not one that's confidently bearish or bullish. What tends to happen after a setup like this is one of two things. Either the negative funding rate and thin volume resolve through continued downside as weak hands capitulate near those support levels Martinez flagged, or the crowded short positioning becomes fuel for a sharp bounce once buyers regain confidence. History with XRP specifically shows both outcomes have played out before under similar conditions, which is exactly why watching the 0.90 level over the next few sessions matters more than trying to predict a direction right now. If you want to actually track this yourself instead of waiting for the next headline, keep an eye on that whale flow number along with funding rates, since both tend to shift before price does rather than after. That's usually your earliest warning, whether it's warning you of more downside or warning you that a reversal might be closer than the price chart suggests. That's today's breakdown here on XRP Financial Horizon. If this kind of on-chain, data-first analysis is useful to you, subscribe so you catch these signals as they happen, instead of finding out after the move already occurred. Tell me in the comments which level you think holds first, and I'll see you in the next one.